Hello everyone, myself Pavitra, Assistant Professor, Department of Commerce from St.Josephs College of Arts and Science for Women, Osur. Today topic is Introduction of Audit Risk. Agenda: Introduction, Audit Risk, Assessment of Risk. Risk assessment and internal control are two fundamental concepts in the field of auditing and financial management. They play a critical role in ensuring the reliability of financial information, safeguarding assets, and achieving organizational objectives. Risk assessment involves identifying, evaluating, and addressing potential risks that could impact on organizational ability to achieve its goals. In the context of auditing, risk assessment is a key step in planning an audit engagement. It helps auditors understand the organization's operations, internal control, and the potential for material misstatements in the financial statements. In the context of auditing, risk assessment is a key step in planning an audit engagement. It helps auditors understand the organization's operations, internal control, and the potential for material misstatements in the financial statements. The goal of risk assessment is to focus audit efforts on areas with the highest risk of errors and fraud. Auditors identify and understand the risks that could affect the organization's financial reporting. These risks could be related to industry factors, economic conditions, regulatory changes, and more. Audit risk is the risk that auditors face when they issue an incorrect opinion on the financial statements, leading to the possibility that the statements are materially misstated. It is a fundamental concept in auditing that auditors consider when planning and performing an audit. In other words, audit risk is the overall risk that the auditor is willing to accept for issuing a good opinion. Components of audit risk. First one, inherent risk. Inherent risk is the susceptibility of an assertion in the financial statements to material misstatements even in the absence of controls. It is influenced by factors such as complexity, industry characteristics, and inherent weakness in the accounting process. Second one, control risk. Control risk is the risk that internal controls will fail to prevent or detect material misstatements in the financial statements. It depends on the effectiveness of an organization's internal controls. Third one, detection risk. Detection risk is the risk that audit procedures will fail to detect material misstatements that exist in the financial statements. It is controlled by the nature, timing, and extent of audit procedures performed by the auditor. To sum up, audit risk influences audit planning, procedures, and the ultimate audit opinion. Auditors aim to manage audit risk by assessing inherent risk, control risk, and detection risk to ensure that the financial statements are fairly presented and free from material statement. Next, assessment of risk. The assessment of risk involves identifying, evaluating, and addressing risks that could affect the accuracy and reliability of an organization's financial statements. Effective risk assessment allows auditors to tailor their audit procedures to focus on areas with higher risks of material misstatements. This helps ensure the audit is conducted efficiently and that the resulting auditing opinion is well informed. Assessment process. First one, understanding the entity and environment. Under that, gain an understanding of the client's business, industry, and operations. Consider external factors that could impact the financial statements. Second point, identifying the risk. So how they are identifying the risk means they identify potential risks that could lead to material misstatements. Third one, assessment inherent risk. In that they evaluate the inherent risk for various accounts and assertions. They assess factors such as complexity, subjectivity, and susceptibility to fraud. Fourth one, assessing control risk. Here, they evaluate the effectiveness of internal control and consider the design and operation of controls. Fifth one, determining the detection risk. Determine the level of detection risk needed to achieve the desired level of audit risk. Adjust detection risk based on the assessed inherent risk and control risk. Next, benefits of risk assessment in auditing. First one, efficient resources allocation. So it focuses audit efforts on areas with higher risks, optimizing the allocation of audit resources. Second one, effective audit planning. Here they develop a well structured audit plan that addresses the identified risk. Third one, enhanced audit quality. Tailor audit procedures to areas of greatest risk, leading to a more thorough and effective audit. Fourth one, informed decision making. It provides reliable and relevant information to assist in decision making by management and stakeholders. Fifth one, increased credibility. To strengthen the credibility and reliability of the audit process and resulting audit opinion. To sum up, the assessment of risk allows auditors to focus their efforts on areas of greatest concern. By evaluating inherent risk, control risk, and detection risk, auditors develop a